Hello and welcome to KYC. I am Sharath Dubey and the company on KYC's radar today is none other than Canara Bank. It's a PSU bank and the numbers also have recently come out as well. But first and foremost, let's understand what we actually want to know about this entire company as a whole. The first question is, of course, the Q2 related, what drove the NII dip? And of course, there is a stronger non-interest income as well, and we will be talking to the management as well on these important questions. Now, second question is, how have the NIMs actually bottomed out and will there be more value unlocking from their arms? That's a very important point because a lot of important listings are happening as well. The third question, of course, is the street is asking is, have the NIMs bottomed out? Most of the banks we are asking it, and we can see that the third and the fourth quarter might be a better option for most of the banks. Strategy behind the sharp growth momentum. What led to this and will this actually sustain? These are the questions we will be asking and we'll be going through across our program. Renewed corporate credit and investment demand, that's also something to look out for. And lastly, the slippages, that's also a question to ask. ECL, which recently RBI had come out, and MSME, is the stress still there or not? So these are the questions we will be addressing for our viewers today. But let me just take you through the entire setup of the KYC of the company, about the company as well, what actually matters about the bank. First and foremost, it's incorporated in 1906, it's a very old bank, and nationalized in the year 1969. Interestingly, Canara Bank with 13 other major commercial banks of India, this was merged in by the government of India. Also, erstwhile it was a syndicate bank, there was a merger there as well on 1st April 2020. There are subsidiaries where the street is very much interested. The listed subsidiaries, especially Canara Robeco AMC recently got listed. Other subsidiaries are also in the offing, and little birdie tells me that there might be more IPOs coming as well. Canfin Homes, Canara Bank, Factors and Canara Bank Securities. Canfin Homes is also separately listed where the majority stake is held by Canara Bank. So the lot of arms, lot of value unlocking is something which we are looking at. But moving to our show, the important rating factors where we judge the company and we give them overall numbers. These include the income statement, the balance sheet, the return ratios. Of course, this is a bank, and asset quality is one of the most important parameters to check. Apart from that, shareholding, street cred, valuation, and lastly, what's the outlook going ahead? These are the parameters where we judge these companies on our show in KYC. But first, let's go to the income statement. Let's pull up the numbers. In the income statement, the 3-year CAGR, net interest income, decent 12% growth coming in, operational profit 11%. But look at the 3-year CAGR of the profit numbers. That has gone up significantly, almost 44 odd %. Interestingly, provisions, these are the numbers also to look at. And these provisions are largely in line. It's been a bit on the downward side, and that is very important as the NPAs come down, and this is a good chart. You can see for the last 3 years how the provisions are falling as well. But the stock is in focus because of its Q2 earnings as well, and we did an extra analysis of this earnings. Strong set of numbers coming in. Net interest income and NIMs, there's a beat happening. Asset quality has improved, that's a very important point. Apart from that, the RAM increase is there of roughly 17 odd %. And it is just an operational setup. Let's look at the cost of funds and credit cost. That has also actually improved as well. Sequentially, looking at the numbers, NPA, GNPA, let's flash them on the screen, where we see a significant downtick coming in on a sequential basis. NIMs also coming at a stable 2.5 odd %. Year-on-year basis, the net interest income, not much there to look at. It's down 2 odd %. And the net profit, however, because of improvement we saw in the asset quality, that number has gone up. So from there, it's a thumbs up coming in for the income statement. Let's move on to the balance sheet. Not much here, and I could say that the deposits number, they're actually below what the industry growth is going at. Not much to look at. CASA also, and overall, the gross advances, they're just in line with what the industry is growing at. That's roughly 12% odd CAGR numbers. So net, nothing much attractive in the balance sheet for Canara Bank, and I'll give a thumbs down for this segment. Moving on, return ratios, these are very important for a bank, and they at times they become very technical to understand and read. The biggest metric I would like to discuss that first, and that is the NIMs. NIMs that has actually been, it has gone up. That's from 2.55% to 2.88%. This looks like small basis points, but for a bank of this size and the numbers when we see operationally, this is actually a very strong move. Now I'm comparing that with June 2025 and September 2024. That means it's on a sequential basis. I'm looking at these numbers. If you see cost of funds, that has been stable and flattish, and that's actually good for a bank coming in at 5.3 odd percent. Yield on funds, yield on investments, these are generally stable operational parameters which you are looking at the screen. But overall, because of other metrics over here, we see that it's on a downward tick. NIMs is also something which I'd like to point out, but net the return ratios I'll still give a down going ahead. Asset quality, that has been the talk of the town, and that's the most important thing even in the earnings as well. GNPAs, look at it, it was earlier in September 24, that was almost at 3.73%, and it's a gradual downtick in June, and then another fall coming in 2.35% for the September quarter. NNPAs, having a look at that, that has also seen each year, if you look at it, there has been a degrowth coming in, and this augurs well. That means the asset quality is improving for the bank, and most of the NPAs, they are getting cleaned up as well. Now, once this happens, the return ratios and important ratios also start going up as well, and it becomes attractive for investors as well. And this is why I'm saying is because the asset quality over here, net, I have given a thumbs up. So that's a very positive look for the company. Shareholding pattern, that's what I have been stating earlier, is the shareholders will come in when we see your bank's books are getting cleaned up, and the interest comes from institutions. And when I speak of institutions, DIs and FIs are something which we track in our show, their entire stake coming in, not much happening. There has been, you could say, a kind of an increase in the overall allocation coming in for the FIs. It's around 10.5%, and that has gone up to almost 12 odd percent. And DIs, there has been a kind of a slight selling coming in, but overall it seems it's still decent. Public, not much. Public has actually reduced their stake. That's very interesting, from 15% to 13 odd percent. And of course, we saw a lot of churn also coming in the PSU banking space. Last year, PSU banking space, there was a lot of noise amongst the retail about getting bullishness, but yes, that has moderated, and that's what we can see in the shareholding numbers as well. Our promoter numbers steady, not much to talk about, but net I will give a neutral rating in this setup. Now let's look at the sixth rating, that is the street cred. What returns have come to the shareholders, and I must say 1 month this has gone up 7%, but in 6 months also, if a medium-term shareholder or a trader who's having position on a medium-term basis, that person has also earned money, 35% gains coming in, and year-to-date also it's decent, 32% outperforming the Nifty PSU banking index as well. 1 year it has been stable, but a multi-bagger. When you look at the 5-year share performance, look at the number 666, 666. So you can see there's a very strong up move coming in for all types of investors or even traders going ahead. And today in the day's trade also, the stock is doing well on the back of earnings as well. So overall, the street cred, this will be a thumbs up for Canara Bank. Up next is the valuations. Valuations on the higher side, I must say the price to book is at 1.1 times. And the 5-year average, that comes at 0.9 times. So right now on the higher end of the valuations, and that is why I would be giving a thumbs down for this criteria. And let's move on to the last rating methodology, and that's the outlook. It's one of the most important things. And firstly, bank has stated in its investor presentation that the margins are likely to remain stable in third quarter, and this is what the entire street is actually talking about. NIMs are expected to range between 2.9 to 3% in the fourth quarter. It's a very important parameter. That's why we keep repeating this in our show. Also, the FY26 net profit, that's expected to surpass the 20,000 crore mark. MSME loan book, that's expected to rise by more than 15% in FY26, and the RAM segment will outpace the corporate book over the next 1 to 1.5%. When I speak about RAM, it means the retail segment. So that is very important. And retail segment, of course, gives a high margin as well and better collection efficiencies. ECL, which is our RBI norms which have come up, they are expected to have a minimal impact on credit costs. Of course, the banks which are having a weaker credit profile, they get impacted more when these ECL norms are announced, and Canara Bank has a better credit profile than most of the PSU banks as well, and that is why the street is giving premium as well. So let's revise all the 8 parameters and let's give you the entire picture. Where does Canara Bank stand? And overall, the income statement that has done well. I have given a thumbs up for it, but balance sheet and return ratios, not much happening there. So there is a thumbs down coming in. But the cherry on the cake, that is the asset quality, strong performance, NNPA, GNPA. That's why we are given a thumbs up rating. Shareholding, not much changes happening, even though a decent exposure in the institution front. Street cred has been good. They have rewarded the investors, they have rewarded the traders, even the positional folks. But the valuations, that's on the higher side. That's why a thumbs down coming in. But overall outlook, there is a improvement happening, and the company's focus on the retail segment makes this a bullish bet in the street. The KYC rating we have given is 4.5 out of 8, and that is where we'll be looking at how this company is actually panning out. To just give us more flavor, now we will be talking to the management as well. We will ask them the questions, what actually matters regarding the business model, the Q2 earnings, and what the outlook would be. And now we are joined by Mr. K Satyanarayana Raju, the MD and CEO of Canara Bank. A very good afternoon, sir, to you. And the first question, of course, would be that the NI numbers, that has dipped. The non-interest income, that rose in Q2. So could you just give us the entire picture, what has happened?
So NII, if you see that the year on year, then there is a dip. But when you see that NII quarter on quarter, there is an improvement in that NII. So that you first, I want to bring it to your notice that it's only year on year it has dipped, but the quarter on quarter it has started picking up again at the NII. So reason is well known to everybody. That's from April to June, within that 3 months, the government has February to the June. The regulator has reduced the repo rate in 3 times. Total, it's in 100 basis points. And in our portfolio, almost 46% of our portfolio asset base is linked with the repo rate. To all these 46% repo rate linked borrowers, we extended this benefit 100 basis points immediately. Whereas in our 90% of term deposits are all fixed in nature, and for the almost more 90% of these deposits are locked for the 1 year. And there we don't have any scope for negotiation of the rate of interest. So we have to extend that whatever we agreed the rate of interest for full whole year. So once this started from February, that reduction in the rate of interest, under such a scenario, always there will be a pressure on our NIMs and the NII. So the interest incomes will come down, but the interest expenses will continue to at a higher level. That is costing us on the present, though the business is growing quite comfortably. The total business is grown above 13%. Both the deposits and advances are going above 13%. But that is not actually that is being compensated to some extent for the whatever the in NII we are losing because of this difference in the rate of interest. But now I think slowly it is stabilizing that has reflected in the September quarter. If you see that NII small growth is there around 130 crores. And in the coming quarters, so slightly it may improve further again in the NII. And but the fourth quarter onwards, it will be visible that the benefit, because the deposit rate of reduction benefit also, it will be visible in our books.
Interesting, Mr. Raju. You spoke about the NIMs. So the number for the NIMs, we just want to get into more details about it. Has that bottomed out at 2.5%? Any kind of a number guidance would you like to give going ahead?
See, if no more rate cuts are there, then I feel that it is a bottom. But if any again rate cut has come for that 25 basis point or anything, then again it may hit the bank balance sheet for another 5 basis point or something. But we expect that we can manage at 2.5 at this level, because slowly our cost of deposit also is coming down. If you see that the quarter on quarter, almost 9 basis points, we could reduce that cost of deposit. But our average yield on advances has reduced only 7 basis points. That means the 2 basis points we got the benefit in the deposit. So slightly we are adjusting towards that. That's why I'm thinking that without any further rate cuts, definitely it is a bottom. But if any further rate cuts are there, we should be ready to absorb that little more for the one more quarter.
Well, that's pretty interesting, and the street will be watching out for the further rate cuts as well, and that will, of course, impact the entire banking sector as well. But Mr. Raju, the RAM growth, the retail segment, has seen has been sharply higher side. Overall, what's the strategy for this growth? Will that wholesale loan book will be coming down, and the focus will be focusing more on the retail segment?
No, actually, the corporate credit, we also have a strong credit growth, and definitely we are none to any other bank. The corporates, there is a flow, good flow is there in the corporate, but it's a strategic call, business call that we want to make it our mixture of this asset is the RAM sector. We want to move towards 60%, and the corporate composition we want to keep it around 40%. We are moving like that for this is the business strategy what we have taken 2.5 years back, and we are moving in that direction. Actually, the 2.5 years back our RAM was only 54. Now we are at 58. I'm sure that by March 2026 it will be at 59, and by next year March financial year we will touch that 60%. That is a stable there. We want to be stable at 60-40%. That's why we are growing faster in the RAM sector. And the corporate, it's not that we don't have any traction or anything. We are not compromising in dispersing because we have kept only 10% growth is comfortable for us in corporate. We are not participating in the rate war and just for to show that a top line growth. We are not compromising on the bottom line. That's why we are comfortably growing at 10%. That's what actually even guidance what we want to give to you is RAM sector will continue to grow above 16 to 17% and corporate will grow at 10%.
That's a very interesting point made by the management. The corporate goes between 16 to 17% and 10 to 11 odd percent when it comes to the wholesale loan lending book as well. And of course, they won't be participating in the rate war. But Mr. Raju, what is your flow for the corporate credit demand looking like? Is there any kind of variation happening? You did mention earlier about what the targets would be looking like. But what's your view on the angle from the flows front?
Demand across the board is there, but we are not entertaining the proposal where we feel that commercially it is not feasible for us. But we are entertaining only where there is a terms and conditions matching is there based on our requirements. There, such proposals we are entertaining. Definitely, infrastructure there is a good traction is there. Data center creation good traction is there. Green energy good traction is there. Manufacturing of green energy related activities like solar panel, cell manufacturing, solar panel manufacturing, battery manufacturing, lithium battery manufacturing, and real estate also. I am seeing that good traction is there. This type of and even infrastructure related manufacturing, steel and cement, also we are seeing that traction. This is continuing that. But only thing we are looking at, we don't want to earlier we used to be actively participate in lending to a established AAA rated NBFC or even government undertakings at a competitive pricing. Now presently we are not taking that exposures at such a low pricing. We don't want to be part of that. Whereas private corporates and all, because we get average yield is around 8%, above 8%. In all those proposals, we are actively considering. Even many of the proposals we are underwriting and we are selling to other banking partners.
Well, that's a very detailed analysis coming in from Mr. Raju. But overall, there is a fresh investment demand coming too, right, from the corporates. And if that is happening, if you could just give us a kind of a quantity on that and also shed some more light on this.
So mostly we are seeing in the green field projects only. The brown field is limited tractions are we are seeing that. So the tractions are there, but not so much what we have seen earlier 2 years back. That much is not there on the brown field. But green field definitely in these areas because there is a lot of demand is there, a lot of scope is there. So these areas, the greenfield projects, so much it is coming. But infrastructure, existing parties only is coming for the additional facilities.
Well, that's pretty interesting. Greenfield areas, that's the important buzzword coming in. But Mr. Raju, let's delve deep into your understanding of the Q2 numbers and also overall in the current situation in the banking space. How will you curb the MSME and agri slippages? This has been bothering the entire industry technically, but any green shoots coming in What would be your, fighting strategy for this?
No, just 2 years back, the same agriculture used to be slipped around 1,000 crores per quarter. MSME used to slip around 1,200 to 1,300 per quarter. Retail used to slip around 500 to 600 crores. But because of the 2 years, whatever the initiatives we have taken in underwriting standards and all those things, now per quarter the agriculture has come down to 750, retail 350, and MSME to 900. So there is a reduction, and this reduction will be in gradual. It can't be in so steep because, and of course, whatever the present slippages, it is well within our appetite. And when you are doing the business, this much slippages generally you should expect that, and you should not be too much worry or focus on that. That's whatever the initiatives it is there, but the reduction will happen gradually.
Well, that's a very interesting point made by Mr. Raju. But just a follow-up question on the same thing. Does this Canara Bank want to make use of RBI's easing of capital market exposures and acquisition finance? These two are the new RBI announcements coming in to make a life easier for financial institutions. But is there much more to the details which we cannot see? What would be an industry perspective on that?
The capital market exposure to liberalization, this is expected lines, and that in anticipation of this expected liberalization only, in the April, we have introduced the online STP process, a new product, loan against the mutual fund investments. So that has got a good traction, and many youngsters are participating in that. And now, because of the limits have been enhanced, I am sure that we can grab the market much better. And simultaneously, that's the reason actually we are strengthening our another subsidiary, that is Canara Bank Securities Limited. We are injecting a fresh capital. Also, we are onboarding new platforms for that. Canara, see, it is actively we are making that company actively. See, earlier it was not so active. Take the advantage of capital market progress, whatever it is there. Regarding the acquisition or the finding. That is definitely we are part of that progress. It is a new opportunity that RBI has opened the doors for us. Earlier, we used to lose these opportunities. Many of the foreign banks or foreign funding agencies used to get the benefit. Now, Indian banks are also have been opened the doors. We take this advantage, and that's the reason we are building that our capabilities already. The existing whatever the specialists are there, the officer level or executive level, we are sending them for specialized trainings, both abroad and the domestic specialized institutions. We are first working on capability buildings, and policy also we are framing on that. We will be actively participating in that.
Yeah, that's pretty interesting, new geographies, new business lines, and even the new audience. What initially people have the perception of your bank, but now you're trying to, put on your feathers in and go into new places. That's interesting. But what is your response for the acquisition finance draft norms? Are you saying something specific to the RBI? What's your view as an industry player? What would be your comments on this?
No, definitely. We are given a feedback to take the feedback from the field functionaries to the concerned our risk department. They are consolidating it. Once that has come, we will give our suggestions to that regulator. It is a regular practice. Whenever they come for some guidelines, we always the regulator expects us to give the feedback, and we share our feedback. Based on that, they take modifications also.
Well, that's pretty interesting about the feedback. We discussed about both of these RBI norms coming in, but the street wants to know, is there any financial impact, ECL norms? If it is there, can you quantify? You had stated earlier that there won't be much impact, but in case if there is any quantification, please go ahead, sir.
Yes, I too agree with you that the impact will be very much limited. And most of the banks, including the Canara banks, last 1 year we are working on creating that buffers in that against the standard assets itself. Whenever it is appearing, any big account is appearing in the SMA, even at the 0 or level also, 0 or 1 level, we are providing additional provisionings every quarter. Previous two quarters, we have provided almost 580 crores. This quarter also, we provided against for one account 380 crores. These are all additional cushions, buffers we are creating for that future for transformation when the accounting system has gone to for that from 1st April 2027 onwards. We are all likely to shift it to this expected credit loss accounting system. By that time, we will be ready. And since we are already creating buffers, the impact will be very minimum. I don't think it will be so visible. Impact will be there on our balance sheet or ratios.
Minimum impact on the ECL numbers, which Mr. Raju has stated. Thank you very much, sir, for joining us and giving your views in our special show, KYC at NDTV Profit. But for our viewers who have tuned in, thoda der pehle, let's say that's more important is what the show has been, what rating we have given, and also we'll share the important takeaways also. Largely income statement, it is a positive reaction coming in, not much in balance sheet and return ratios. Asset quality has been given a thumbs up. Shareholding, it's neutral. Street credit has given good returns. Valuations on the higher side, and outlook, that is what the street is cheering for. But overall, it's 4.5 out of 8. And interestingly, we have also got you the management, Mr. Raju speaking about the company, but the takeaways is there's a fast growth in the retail book expected, 16 to 17% growth coming in. They're expecting, NIMs are expected to bottom out if no rate cut is there. That means we can expect in the third or fourth quarter. And lastly, I'd like to say that there is no participation in the rate war which the bank wants to do for just top line growth as they are stating to the peers. So that's shots fired coming in from Canara Bank. But that's all the important management takeaways which I'd like to point about. And that's it. Thanks for tuning in to KYC only on NDTV Profit.